As the market is closed for the weekend, Applied Digital Corporation, ticker APLD, last traded at $30.98 at the bell on Friday, November 7th, 2025. Now, the expectation for a company that used to be called Applied Blockchain is that it's just another volatile crypto mining play chained to the price of Bitcoin, something you might speculatively trade on the Robinhood app when you're feeling lucky. The reality, however, is that this company has executed one of the most significant pivots in the tech sector, and its future is now almost entirely tied to the massive build-out of artificial intelligence infrastructure. The old name is a distraction. The real story is about high-performance computing, or HPC. This isn't about Robinhood crypto. This is about building the physical data centers that house the tens of thousands of GPUs that make Nvidia stock one of the most valuable companies in the world. This is the critical insight that separates the casual observer from the serious analyst, and it's why this stock has been on an absolute tear, moving from a 52-week low of just $3.31 to a high of $40.20. The market is slowly waking up to the reality that APLD is no longer a blockchain company, but a premier picks and shovels play on the entire AI supercycle. The common belief, the one held by investors who haven't looked at the filing since 2023, is that APLD is a high-risk gamble, a company that rents out space for crypto miners, and thus its fate rises and falls with digital assets. This is the narrative that causes many to dismiss it. But the deeper take, the reality that is driving institutional interest, is found in one name: CoreWeave. Applied Digital has secured massive, long-term contracts with CoreWeave, a leading specialized cloud provider for AI, to build out its data centers. This isn't a small-time deal. This partnership was recently expanded to cover 400 megawatts of capacity, representing a staggering $11 billion in total contract value spread over the next 15 years. This single move provides a level of revenue visibility that is almost unheard of for a company of this size. It fundamentally changes the business model from speculative hosting to a long-term utility-like infrastructure provider for the most powerful industry on Earth. This is why analysts are so bullish, with firms like Craig-Hallum setting $39 targets and the consensus average sitting north of $41, implying significant upside even from here. The recent earnings report on October 9th for the first quarter of fiscal year 2026 confirmed this momentum. The company posted an earnings beat with a loss per share of only 3 cents, which was dramatically better than the 14-cent loss Wall Street had braced for. That's the kind of positive surprise that forces a total reevaluation of a company's trajectory. Let's look at the recent stock movement because it tells this story of tension perfectly. That last closing day, Friday, November 7th, was a microcosm of the entire APLD narrative. The stock traded in an incredibly wide range, from a low of $28.01 all the way up to $31.22, before settling at $30.98. The volume was immense, with over 26.6 million shares changing hands. This is not quiet accumulation. This is a battleground. This is the old crypto narrative fighting against the new AI infrastructure reality. The stock has surged over 300% in the past year, far outpacing even high flyers like Tesla stock. This kind of volatility is why this isn't a stock for a set-it-and-forget-it Schwab Intelligent Portfolios account or a simple SoFi robo-advisor. This is a stock for active online investing, when you watch closely on your Fidelity mobile app or through the advanced charting tools on the Interactive Brokers platform. The institutional activity is just as intense. We've seen over 500 institutions take positions, holding over 176 million shares. And the most significant name on that list? Nvidia Corp itself. Nvidia is an institutional shareholder. Let that sink in. The company that makes the AI chips has taken a direct stake in the company that builds the data centers to house those chips. This is an incredible vote of confidence and a powerful signal that APLD is a critical part of the AI supply chain. This isn't just a SoFi Invest customer buying a few SoFi ETFs. This is the undisputed king of AI putting his own capital on the line. So what does Applied Digital actually do? The company designs, engineers, builds, and operates these next-generation data centers. Think of them as specialized high-tech landlords. While a traditional data center might be built for web hosting or storage, APLD's facilities are purpose-built for the extreme power and cooling demands of high-performance computing. An AI model being trained on thousands of Nvidia H100s or B200s generates a heat load and requires a power density that is orders of magnitude greater than traditional servers. APLD specializes in this, particularly in liquid cooling solutions, which are becoming essential. Their strategy involves building these facilities like their massive campus in North Dakota and then signing long-term, high-value leases with tenants like CoreWeave. This pivot away from the blockchain business, which is now a legacy operation, was a stroke of genius. It allowed them to leverage their expertise in building power-dense facilities and apply it to a much larger, more stable, and faster-growing market. They are in essence building the roads and bridges for the AI gold rush. While many investors are looking for investment help to find the next hot AI software company, the smarter investment might be in the infrastructure that makes all of it possible. Whether you're a self-investing pro using interactive broker stock trading or just starting your online investment with Fidelity Investments, understanding this business model is key. Now, we must address the other side of the coin, the reality check. The $11 billion contract is the expectation, but the reality of the balance sheet presents the single greatest risk. Building data centers is astronomically expensive. It is a capital-intensive business, and APLD's financials are tight. As of the last report, the company's short-term assets of around $642 million did not cover its short-term liabilities, which stood at over $985 million. That is a significant working capital deficit. Furthermore, its total debt load is high, around $687 million. Most concerning is the cash runway. Based on its free cash flow burn rate, some analyses indicated a very short runway of only a few months. The company has since noted it raised additional capital, but this remains the central point of tension. The market is making a bet. It's betting that APLD can successfully finance this massive build-out using its $11 billion in contracted revenue as collateral to secure the financing it needs to bridge this gap. This is a race against time. Can they build the facilities and get them online, generating revenue from CoreWeave before their cash burn and debt covenants become a critical problem? This is the high-stakes drama playing out right now. This is why the stock is so volatile. The bulls, who might be using SoFi Invest or Robinhood to build a position, see the $11 billion prize. The bears, pointing to the balance sheet, see a potential liquidity trap. Looking to the future, the outlook is a story of two possible scenarios. Scenario 1, the bullish case, is that APLD successfully executes. It manages its financing, completes construction on its data center campuses, and begins to recognize the massive recurring revenue streams from its CoreWeave contract. In this scenario, the company's earnings and cash flow would transform dramatically. The stock would likely re-rate from a speculative builder to a premium infrastructure provider, and those $41 and $56 targets would not only be met, but possibly exceeded. The company would prove that the reality of its AI pivot was even more profitable than the expectation. Scenario 2, the bearish case, is that the company fails to manage its liquidity. The high interest rate environment makes financing too expensive, construction delays occur, or the capital markets turn their back. In this reality, the $11 billion contract becomes a liability, a promise they can't afford to fulfill. This is the risk that must be understood by anyone managing their own individual brokerage account. This isn't a safe Fidelity mutual funds or Fidelity ETFs position, it's a high-conviction, high-risk bet on execution. The catalysts to watch are therefore all related to financing and construction. Every 8K filing that announces a new credit facility, a financing deal, or a construction milestone is a major event. And of course, the next earnings call, expected in January 2026, will be critical for an update on the cash position. Comment below with your thoughts. Do you believe APLD will successfully bridge its financing gap to realize that $11 billion contract? This stock is one of the most interesting stories on the market, one you can trade on any of the major investing sites, from the Fidelity trading platform to the SoFi trading platform. It's a prime example of expectation versus reality. The expectation,